Welcome back. This is Mortgage 101. I'm Dan Olstrand, and he is Clinton Wilkins. It's Financial Literacy Month, Clinton's favorite month of the year, and that even counts December, folks. I'm not even kidding.
That's high, isn't it?
He likes Financial Literacy Month more than he likes Christmas. That's the kind of guy that Clinton Wilkins
No,
is.
just wait until January. We have a good month coming up in January, so I'm really good with November, though.
Fair enough. And we're going to discuss some of the things that you need to keep in mind, maybe give you a little bit of knowledge, more tools in the toolbox for you to not only if you're looking to buy a house or if you're looking to get into a new mortgage or whatever, but just to be able to function in today's world, because as we said in the last segment of the show, things are changing around here a lot, and with the ongoings with the United States and the tariffs and Trump and all of those other things, there's a lot of things that you need to keep in mind.
For sure. And, one of the main things that we talk about around financial literacy is income.
Right.
That's really the cornerstone on people's personal finance. And I think there's so much, uncertainty around income, the different income types. And more Canadians every day are becoming self-employed.
So, Clinton, when somebody comes to your office and they're sitting in a chair across the desk from you, and they're either getting into the mortgage market for the first time, they're renewing, they're looking at you at whatever product they're looking for, is income. Is that the biggest factor that you look at when somebody is looking to do some business with you?
I wouldn't say it's the biggest factor. We think of all of kind of the cornerstones of income, assets, and credit to be important, but it's the first thing we ask about because we need to understand, what can people afford to pay? When we're talking about the 5 C's of credit, characters 1, obviously that's maybe more around, the credit and how are they paying. But we also talk about, their affordability, and that really is tied to what that income is. And, people have all kinds of different income sources now. Before, I think it was really easy. Like we would just get
a 9 to 5, and that was
a 9 to 5. We get a job letter and a pay stub, or a pay stub and a T4, and call it a day. But now, there's a lot of people who are subcontractors.
Right.
There's people that are on pension income. There's people that are working and have a pension. There's a lot of self-employed individuals and a lot of different kind of schemes on how people are paid. And, it's almost like putting a little bit of a puzzle together. And I think that's why I love mortgage lending so much. Every file is like a snowflake. And, it's really about looking at that puzzle and then presenting the best foot forward. Oftentimes, I say a lot of people are self-employed. More and more of our customers are self-employed. I think primarily because bank lenders and people at the branch, they don't understand self-employed as much as we do because we're doing this every day.
Right.
Different types of self-employment. Some people own corporations. There's partnerships and there's sole proprietorships. But I will say there are the most options out there right now for self-employed people than there ever have been in terms of mortgage lending. The banks are certainly more willing to lend to self-employed today than they ever have been. And I think part of that was a mandate from the federal government. Trudeau actually came out during his government saying that, banks, we need to be better with these self-employed folks just because more Canadians are becoming self-employed. So we'll look at things like, let's say there's somebody who was a plumber for 2 years, and then this year they become self-employed. Normally in the old school world, for them to get like a full normal verification of their income, we need them to be self-employed for 2 full tax periods to be able to use their income. Now what we'll do is we'll look at their previous income, as long as it's the same industry, to justify what their future income will look like. Yeah, sure. We may want some verification of that you're making money right now, like maybe contracts, maybe your bank statements, maybe some internal financials or something like that. But there's certainly more willingness to make it work with a normal prime lender. There also is stated income programs, and, there are stated income programs through Sagen and Canada Guarantee, which if someone's buying a home, they can still get a high ratio purchase, but with as little as putting down 10%. I mean, it might not be 5% like a normal consumer could get when there's verification of income. But if you are self-employed and you have 2 years of your taxes, that's something that we can certainly get approved just as much as someone having a job letter and a pay stub for self-employed.
Clinton, I would imagine one of the big questions that you get asked probably daily is there a magic number, particularly in the Halifax real estate market? How much money do we as dual incomes, or as a single income, have to make in order to qualify to get into the housing market for the first time?
That's a great question, Dan. It really has to depend on what the down payment is. But let's say it's a minimum down payment of 5% because that's what it is. If you're buying a home up to $500,000, you could put as little as 5% down. that number is probably around $125,000 to buy a $500,000 house. Yeah, we might be able to make it work depending on what the rates are, 100, 120. It really depends on what that indebtedness is as well and what the operating expenses are of that home. So there's a lot of things that go into account when we're doing a mortgage approval. But I usually say the magic number is we can qualify for someone for about 4 times their annual income in terms of a mortgage. So if the income is $100,000, we can qualify them for a $400,000 mortgage. Right now, the average house price in Halifax is more about $600,000. So we probably need $125,000 or $150,000 worth of income in a household to buy an average home in Halifax. But obviously, everybody's situation is different because we're looking at their debt, we're looking at their income. But we look at the entire picture because people have income coming from all different sources, Dan. People have self-employment. People that have kids, we look at their child tax benefit. We're going down the rabbit hole here. We're looking at pensions. We're looking at every possible source of income that we can verify that the lenders will accept, we will use. Because for us, it's more important to get the full picture than it is to just say, hey, give me your job letter and a pay stub. That's lazy. And I see borrowers coming from other financial institutions to say, well, I don't qualify, but I think with another lender, but I actually think that I might. Will you do a deeper dive into this and, ask me some more questions and gather these documents? And for us, I'd rather put in a little bit of extra effort and get the best possible result for a consumer. And I think customers sometimes need to have a realistic expectation of what is possible as well. I think that sometimes we have our wants kind of outweigh our ability. And we want to ensure that when we get someone an approval, they're not sitting in their home, not being able to furnish it and needing to eat craft dinner. I personally love craft dinner, and I've said that before on the show, but you don't want to be forced into that type of scenario. And that's why for me, verifying the income and making sure that income is going to be sustainable, I'm not doing this to be difficult. I'm doing this to protect the consumer. And 2, I'm doing this to protect the lender because I want to make sure that this is going to be sustainable.
Bank of mom and dad. We hear it a lot now that parents are helping their kids with down payments or giving them their inheritance early. Do you see that a lot? Huge.
When I first started doing this 20 years ago, and I love doing this more today than I did 20 years ago, I will say that, the average gift was $5,000, $20,000. $20,000 was probably a big gift back then. Now I see many gifts from family, $100,000. More than $100,000, I think, is the average. It's like $117,000 is the average family gift coming in now. Wow. If we look across the country.
Holy smokes.
Part of the reason is young people, or even I'll just say first-time home buyers, for them to break in the market.
It's tough.
Very tough. And they need these big gifts because maybe they don't have $125,000 or $150,000 worth of household income to get into an average house. But guess what? If they're coming with a big gift, that'll help them, usually afford a purchase price above what they would normally qualify for.
Or would that also help to get a larger down payment so then you avoid some of the fees like the CMHC?
Exactly. If you can put down 20%, then you're avoiding the CMHC fee, and it's always cheaper to put down 20% than it is to get a high ratio mortgage. Even though the rates on a high ratio mortgage are less, Dan, the rates on a conventional are a little bit more, but it also gives you the flexibility to go to a 30-year amortization regardless if you're a first-time home buyer or not. So if people have 20% down, I always think that's the way to go.
So to sum up the income segment of the show here, Clinton, it's not just what you're making at your job that will be the determining factor for your mortgage when they come to visit somebody like you.
Exactly. We look at all different sources. It may be self-employment. It may be child tax benefit. It might be pension income. It might be Veterans Affairs. Like, we literally take every possible income source into consideration to have the best possible outcome for a consumer. And that's where I think it's so important to seek the advice of an unbiased mortgage professional, because they're looking at that full scope. Not just, hey, here's a job letter and a pay stub. I want to dig a little bit deeper. I want to ask some more questions, and I want to probe because I want to make sure that I'm going to be giving the best advice as well.
It's got to be a difficult conversation. We've only got about 40 seconds left here before we have to take our next break.
Mm-hmm.
That has to be a deep dive conversation with people who maybe think that they aren't as the commercial says, aren't as rich as they think.
Yeah, exactly. I think that might be an old Scotiabank adage. Maybe they are richer than they think. I'm not sure. But for us, we need to really do that deep dive, and we're breaking down some of these barriers. When a customer talks to me, sometimes they're nervous. They've never been, in front of a mortgage broker before, or never, really gone and sought credit. So for me, asking the questions, it's about building that plan.
If you've liked what you've heard and you want to learn more, feel free to visit us online at teamclinton.ca.